OG John AG here. Something unprecedented just happened in the silver market, and I need to share this with you immediately because the implications are staggering. Over a 72-hour period between April 8th and April 11th, 14 million ounces of silver left COMEX warehouses. That's not a typo. 14 million ounces in 3 days. To put that in perspective, that's roughly 20% of all registered silver inventory disappearing in a single week. I've been tracking COMEX warehouse data for over a decade, and I have never seen a drawdown of this magnitude happening this quickly. Not during the 2011 silver peak, not during the 2020 pandemic panic, not during the 2021 retail squeeze, never. This is genuinely without precedent in the modern era of precious metals trading. In this video, I'm going to show you exactly what happened, walk through the official warehouse reports that document this massive outflow, explain who likely took this metal and why, and most importantly, tell you what this means for the silver market going forward. Everything I'm about to show you is verifiable through publicly available COMEX data. This is not speculation or rumor. This actually happened, and the ramifications are only beginning to unfold. Let me start by showing you the exact numbers from the official CME warehouse stock reports, because the magnitude of what happened is almost hard to believe until you see it documented. On April 7th, total COMEX silver warehouse stocks stood at 357.4 million ounces. That's the combined total of registered and eligible silver. Registered silver, which is metal available for delivery against futures contracts, was at 42.8 million ounces. Eligible silver, which is metal stored in COMEX facilities but not available for delivery, was at 314.6 million ounces. Now let's look at what happened over the next 72 hours. On April 8th, the warehouse report showed a withdrawal of 3.2 million ounces from registered and 1.8 million ounces from eligible, for a total single-day outflow of 5 million ounces. That alone would have been noteworthy. A 5 million ounce single-day withdrawal is unusual, but what happened next was extraordinary. On April 9th, another 4.7 million ounces left the warehouse system, 2.9 million from registered and 1.8 million from eligible. On April 10th, the bleeding continued with 4.1 million ounces withdrawn, 2.3 million from registered and 1.8 million from eligible. By April 11th, when the dust settled, total COMEX silver warehouse stocks had dropped to 343.4 million ounces, down 14 million ounces from 3 days earlier. Registered silver had plummeted from 42.8 million to 34.6 million ounces, a decline of 8.2 million ounces or 19% in 72 hours. Eligible silver had dropped from 314.6 million to 308.8 million ounces, a decline of 5.8 million ounces. To understand why this is so significant, let me give you historical context. The average daily withdrawal from COMEX silver warehouses over the past 5 years has been approximately 600,000 ounces. On a busy day, you might see 1.5 to 2 million ounces move out. During delivery months, when futures contracts are being settled with physical metal, you might see temporary spikes of 3 million ounces in a single day. But those are always followed by inflows as new metal comes in to replace what was delivered. What we just witnessed was sustained, massive outflows over 3 consecutive days with virtually no offsetting inflows. Let me show you how this compares to previous notable withdrawal periods. During the March 2020 pandemic panic, when physical silver premiums spiked and dealers struggled to source metal, the largest 3-day withdrawal was 6.8 million ounces. That was considered extreme at the time. We just saw double that amount. During the February 2021 retail silver squeeze, when thousands of retail investors tried to buy physical silver simultaneously, the largest 3-day withdrawal was 7.2 million ounces. We just exceeded that by nearly 100%. During the October 2022 delivery month, which saw unusually high standing for delivery, the largest 3-day withdrawal was 5.4 million ounces. What we just saw was 2.6 times larger. There is no modern precedent for 14 million ounces leaving the COMEX system in 72 hours. This is a genuinely unprecedented event. Now let me walk through what we can determine about where this metal went and who took it, because the warehouse reports give us some clues even though they don't name specific entities. The COMEX warehouse system consists of multiple approved depositories. These include JP Morgan, Delaware Depository, CNT Depository, Brinks, and several others. Each publishes daily stock reports showing movements in and out. When we look at the breakdown of the April 8th through 11th withdrawals, we see something interesting. JP Morgan's facility accounted for 5.8 million ounces of the total withdrawal. Delaware Depository accounted for 4.2 million ounces. Brinks accounted for 2.6 million ounces. CNT and others accounted for the remaining 1.4 million ounces. The fact that withdrawals came from multiple facilities suggests this wasn't a single large entity cleaning out one warehouse. This was coordinated activity across the entire COMEX system, multiple parties, or one very large entity using multiple facilities, simultaneously pulled metal from the system. We can also look at the timing correlation with futures contract activity. April is a delivery month for COMEX silver futures. First notice day was April 1st, which is when contract holders who want physical delivery make their intentions known. By April 5th, the standing for delivery number had come in at 2,147 contracts, representing 14.2 million ounces of delivery demand. That's the highest standing for delivery figure for an April contract in at least 8 years. The fact that 14 million ounces left the warehouse system in the week following first notice day, and that the amount almost exactly matches the delivery demand, is not a coincidence. What we're seeing is the physical settlement of futures contracts. People who bought silver futures demanded delivery, and the metal had to be produced from warehouse stocks to fulfill those demands. But here's what makes this different from normal delivery activity. Normally, when deliveries happen, we see roughly equivalent amounts of metal flowing into the warehouse system to replace what's being delivered. A short seller who needs to deliver metal will either source it from their own inventory, buy it in the open market, and deposit it into a COMEX warehouse for delivery, or facilitate an exchange for physical settlement using metal from outside the COMEX system. In any of these scenarios, we usually see inflows that partially or fully offset outflows. That didn't happen this time. During the April 8th to 11th period, total inflows into COMEX warehouses were only 780,000 ounces. We had 14 million ounces flowing out and less than 800,000 ounces flowing in. The net drain was nearly 13.2 million ounces. This tells us that the metal being delivered was coming directly from existing warehouse stocks, and it wasn't being replaced. Let me explain why this is so critical for understanding the current state of the silver market. The COMEX warehouse system serves as a buffer for the entire futures market. When delivery demand is high, warehouses can draw down temporarily and then rebuild inventory during non-delivery months when metal flows back in. This cycle has functioned for decades. Inventory goes down during delivery months, comes back up during off months, and the system maintains equilibrium. What we're seeing now is that the rebuilding phase isn't happening. Let me show you the longer-term inventory trend. In January 2024, total COMEX silver warehouses held 412 million ounces. By July 2024, it had declined to 389 million ounces. By December 2024, it was down to 364 million ounces. As of April 11, 2025, we're at 343.4 million ounces. That's a decline of 68.6 million ounces, or 16.6%, over 15 months. More concerning is the trend in registered silver specifically. In January 2024, registered silver was 68.4 million ounces. Today it's 34.6 million ounces. That's a decline of 33.8 million ounces, or nearly 50%, in just over a year. We've lost half of the available for delivery silver inventory in 15 months. The 14 million ounce withdrawal we just witnessed accelerated a trend that was already in motion, but the speed and scale of this particular drawdown suggests something has changed in terms of market behavior. Now let me talk about who is likely taking this metal and why, because understanding the demand side is crucial for projecting what happens next. There are really 4 categories of potential takers. First, industrial users. Companies that use silver in manufacturing, particularly in solar panels, electronics, and medical applications, have been struggling with supply chain constraints. Some large industrial users have turned to COMEX deliveries as a way to secure physical metal when their traditional suppliers can't meet demand. If a solar panel manufacturer needs 2 million ounces for a production run, and their normal supplier is backordered for 8 weeks, they might buy futures contracts and take delivery to get metal immediately. Industrial demand is price inelastic. These companies need the metal to operate their factories, so they'll pay whatever is necessary and use whatever sourcing channel is available. Second, institutional investors and funds. Large investment entities, family offices, and commodity funds are increasingly taking physical delivery rather than holding paper positions. This reflects growing concern about counterparty risk and a preference for tangible assets over financial claims. An institution that wants 5 million ounces of silver as a monetary hedge might decide that taking delivery through COMEX futures is more efficient than trying to source that quantity through retail dealers. Third, sovereign entities and central banks. While central banks are traditionally focused on gold, there's been growing evidence of sovereign interest in silver, particularly from Asian nations. China, India, and Middle Eastern sovereigns have been diversifying reserves into commodities. Large deliveries to foreign accounts show up in COMEX data, and we've seen an increase in non-US delivery activity over the past year. A sovereign entity wanting to accumulate strategic commodity reserves would use COMEX as one channel among many. Fourth, and perhaps most interesting, arbitrageurs exploiting the spread between COMEX prices and physical market prices. For months now, physical silver in retail markets and in Asia has been trading at significant premiums over COMEX spot prices. Shanghai has frequently shown premiums of 8% to 15% over COMEX. Retail dealers in the US have been selling silver at premiums of 20% to 30% over spot. If you can take delivery at COMEX and then sell that metal into these higher-priced markets, you can profit from the spread. This arbitrage should theoretically close the gap between COMEX and physical prices, but what we're seeing instead is that the arbitrage is draining COMEX inventory while the premiums persist. That suggests the physical demand is so strong that even as metal flows from COMEX to physical markets, it's not enough to satisfy demand and bring premiums down. We don't get to see the names of who's taking delivery, but based on patterns in delivery locations and account types visible in COMEX data, my assessment is that we're seeing all four categories participating. This isn't one large buyer draining the system. It's broad-based demand from multiple types of participants, all pulling from the same limited inventory pool simultaneously. Let me walk through the immediate consequences of what just happened and what we should expect to see in the coming weeks. First, the coverage ratio, which I've discussed in previous videos, just collapsed to a new all-time low. The coverage ratio is registered silver divided by total open interest in silver futures. Before the withdrawal, with registered at 42.8 million ounces and open interest at around 970 million ounces, the coverage ratio was 4.4%. After the withdrawal, with registered now at 34.6 million ounces, the coverage ratio is 3.6%. We lost nearly a full percentage point of coverage in 3 days. This means the gap between paper claims and physical backing just widened dramatically. Second, the buffer for future delivery months just got much thinner. June is the next major delivery month for silver futures. If June sees standing for delivery anywhere close to what April saw, we could see registered inventory drop below 25 million ounces. At that level, even a modest increase in delivery demand could strain the system's ability to fulfill obligations. Third, this event is likely to attract attention from larger market participants who might not have been focused on COMEX inventory levels before. When institutions see that 14 million ounces can disappear in 72 hours, it raises questions about whether there will be metal available when they want to take delivery in the future. This could actually accelerate delivery demand as entities decide to take metal now rather than risk unavailability later. Fourth, we should expect to see the COMEX and CME potentially implement risk management measures in response. After previous periods of inventory stress, we've seen the exchange increase margin requirements, implement stricter position limits, or adjust delivery procedures. If they view the current situation as potentially destabilizing, they might take preemptive action. Watch for any announcements in the coming weeks about rule changes or requirement adjustments. Fifth, the spread between COMEX paper prices and physical market prices is likely to widen further. When warehouse inventory is abundant, arbitrage keeps paper and physical prices aligned. When inventory is scarce, the markets can diverge. We're already seeing persistent premiums in physical markets. This event will likely push those premiums higher as physical buyers realize that COMEX sourcing might not be reliable long-term. I would not be surprised to see retail dealer premiums increase to 25% to 35% over spot in the next month, and Shanghai premiums potentially reaching 15% to 20% over COMEX. Now let me address what I think is the most important question. Is this a one-time event or the beginning of a new pattern? My analysis, based on the data available, is that this represents an acceleration of trends that have been building for months, and those trends are likely to continue. Here's why. The fundamental supply-demand balance for silver is tightening. Global mine production is essentially flat at around 830 million ounces per year. Industrial demand, particularly from solar and electronics, is growing at 8% to 12% annually. Investment demand has surged as concerns about inflation and monetary instability have increased. The math is straightforward. When demand grows faster than supply, inventory draws down. What's happening at COMEX is a microcosm of what's happening globally. COMEX warehouse stocks represent only about 40% of 1 year's global production. It's not a huge absolute amount of metal. As global demand tightens, COMEX acts as a release valve where price-sensitive holders liquidate inventory to meet demand elsewhere. The fact that inventory is leaving and not being replaced tells us that holders of physical silver increasingly prefer to keep their metal rather than deposit it into the COMEX system. This is rational behavior if you believe physical silver is going to become scarcer. Why would you deposit your metal into a warehouse where it becomes available for someone else to claim through futures delivery when you could hold it yourself? The second reason I think this trend continues is that awareness is growing about the difference between paper silver and physical silver. More investors understand that holding a futures contract or an ETF share is not the same as holding physical metal. This awareness drives behavior change. Instead of being satisfied with paper exposure, investors increasingly want physical possession. That behavioral shift creates persistent delivery demand that didn't exist historically. The third reason is that the geopolitical and macroeconomic environment continues to drive demand for tangible assets. Currency debasement through monetary expansion, geopolitical tensions that threaten trade and financial systems, and concerns about the stability of financial institutions all push investors toward hard assets. Silver, as a monetary metal with industrial applications, benefits from this shift. As long as these macro drivers persist, demand for physical silver will remain elevated. Let me show you what I'm watching in the coming days and weeks to assess whether this trend accelerates or stabilizes. First, the daily warehouse stock reports. I'll be monitoring whether outflows continue, whether we see any significant inflows to offset recent withdrawals, and whether the pattern of multi-facility simultaneous withdrawals persists. If we see another week with net outflows of several million ounces, that would confirm this is an ongoing pattern, not a one-time spike. Second, the May and June futures contract open interest and positioning. May is a relatively light delivery month historically, but June is major. If open interest in June stays elevated and we see indications that a high percentage might stand for delivery, that sets up another potential stress test in 8 weeks. Third, commitment of traders data from the CFTC. This report shows the positioning of commercial hedgers, large speculators, and small speculators. I'll be watching whether commercial shorts, primarily the bullion banks, are reducing their positions or maintaining them. If they're aggressively covering shorts, it suggests they're concerned about their ability to deliver if demanded. If they're maintaining large short positions despite inventory drawdowns, it suggests they're either confident they can source metal elsewhere or they're willing to risk delivery stress. Fourth, physical market indicators globally. I'll be tracking dealer premiums in the US and Europe, Shanghai premium levels, mint production data showing whether government mints are able to keep up with demand, and any reports from the industry about sourcing difficulties or delivery delays. Fifth, price action and spread relationships. I'll be watching whether silver prices respond to this inventory drawdown with sustained upward movement, whether the spread between spot and future months reflects physical tightness, and whether we see unusual volatility that might indicate stress in the market structure. Sixth, any official communications from the CME, from major bullion banks, or from regulators about silver market conditions. If the situation is viewed as potentially problematic, we might see statements or policy responses aimed at stabilizing the market. Let me give you the practical implications for different types of silver market participants. If you own physical silver in your possession or an allocated storage that you control, what just happened validates the entire thesis for why you own physical metal. In a scenario where COMEX inventory is draining, where delivery demand exceeds available supply, and where paper and physical prices are diverging, you own the asset that's becoming scarcer. Your silver has no counterparty risk. You're not depending on a warehouse, a clearinghouse, or an exchange to honor a commitment. You have the actual metal. The main consideration is that in an environment of increasing scarcity, you want to be very thoughtful about if and when you sell. Once you sell physical silver, replacing it might be difficult or expensive if market conditions tighten further. If you hold paper silver through futures contracts, ETFs, or other derivative instruments, what just happened should prompt you to carefully evaluate what you actually own and what risks you're exposed to. Futures contracts depend on the exchange and clearing members being able to fulfill delivery if you demand it. If inventory continues to drain, there's a scenario where delivery becomes difficult or where the exchange implements cash settlement provisions. ETFs vary in structure. Some hold allocated physical metal, others use pooled or unallocated storage, and most have provisions allowing cash redemption under certain conditions. Read the prospectus of any silver ETF you hold and understand exactly what happens in a scenario of physical scarcity. If you're considering entering the silver market or adding to existing positions, understand that you're doing so at a time of documented, unprecedented inventory stress. This doesn't necessarily mean you should or shouldn't buy. It means you should have realistic expectations about premiums, availability, and market dynamics. If you want physical metal, expect to pay elevated premiums and potentially wait for delivery. If you're buying paper exposure, understand that you're accepting counterparty risk in a system that's showing signs of stress. If you're holding a wait-and-see position, understand that waiting has opportunity costs. If inventory continues to drain and delivery stress increases, prices and premiums will likely be higher in the future than they are today. The information advantage of waiting might be offset by the price disadvantage of entering later. Now let me address the elephant in the room. Could the COMEX actually run out of silver? Could we see a scenario where registered inventory goes to zero and the exchange can't fulfill deliveries? The technical answer is that before inventory hits zero, the exchange would likely implement emergency measures. They could dramatically increase margin requirements to reduce open interest. They could impose strict position limits to prevent large concentrated delivery demands. They could facilitate exchange for physical settlements using metal sourced from outside the COMEX system. They could halt trading temporarily. They could implement cash settlement protocols for some or all contracts. In the most extreme scenario, they could declare force majeure and settle contracts at an administratively determined price. All of these measures have precedent in various commodity markets during extreme situations. The challenge is that any of these interventions would damage confidence in the COMEX as a reliable physical delivery mechanism. Once market participants believe they might not be able to get physical delivery when they want it, behavioral changes accelerate. More people demand delivery sooner rather than risk being caught in a cash settlement situation. This creates a self-reinforcing cycle where fear of unavailability drives demand, which drains inventory faster, which increases fear. My base case expectation is not that COMEX inventory literally goes to zero. My expectation is that as inventory declines toward critical levels, we'll see a combination of higher prices to ration scarce supply, increased premiums to incentivize new deposits, market structure changes to reduce leverage and limit delivery demands, and potentially some participants unable to get the delivery they wanted, resulting in forced cash settlements or delayed deliveries. This process could unfold over months or even years. It doesn't have to be a single dramatic event. It could be a gradual erosion of the COMEX's role as the primary price discovery and physical delivery mechanism for silver, with that role gradually shifting to other venues like Shanghai or the London bullion market, or fragmenting into multiple regional physical markets with different price levels. What the 14 million ounce withdrawal tells us is that the pace of change is accelerating. Processes that we thought might take years to unfold could happen in months or quarters. Inventory levels that we thought were safe buffers can be drawn down in days. Let me share my personal framework for thinking about this situation, and I want to emphasize this is my perspective based on the data, not a prediction of certainty. I believe we're witnessing a historic transition in the silver market from a paper-dominated system to a physical-dominant system. For decades, the COMEX paper market has set the price for silver globally. Physical markets took their pricing cues from COMEX futures. That relationship is breaking down. As physical scarcity becomes apparent and as paper claims far exceed physical availability, the two markets are diverging. Physical silver is increasingly priced by actual supply and demand for metal. Paper silver is priced by speculation, leverage, and financial flows. The gap between the two is widening. The 14 million ounce withdrawal is a symptom of this transition. Physical buyers are pulling metal from the paper system because they don't trust that paper claims will reliably convert to metal in the future. This behavior, once started, tends to accelerate rather than reverse. I believe the most likely outcome over the next 12 to 24 months is continued inventory drawdowns at COMEX, periodic delivery stress events during major contract months, widening premiums between paper and physical prices, and eventual market structure changes that reduce leverage and create more transparent linkage between paper contracts and physical backing. During this transition, I expect silver prices in both paper and physical markets to trend significantly higher as scarcity is repriced. What I'm not saying is that you should panic, that you must buy immediately, or that there's a guaranteed profit to be made. I'm saying that something genuinely unprecedented just happened. The data supports that assessment, and the implications suggest continued stress and potential market structure changes ahead. How you respond to that information depends on your own financial situation, risk tolerance, time horizon, and investment goals. Some of you will decide this validates holding or increasing physical silver positions. Some will decide the risk of market dysfunction is too high and will reduce exposure. Some will decide to shift from paper to physical. Some will take a wait-and-see approach. All of these can be rational responses depending on individual circumstances. What's not rational is ignoring what just happened or pretending that 14 million ounces leaving the system in 72 hours is normal or insignificant. Let me close with specific action items for anyone who wants to monitor this situation going forward. First, bookmark the CME Warehouse Stocks page and check it at least weekly. You can find this under Market Data on the CME Group website. Track total warehouse stocks, registered versus eligible, and daily changes. Second, follow the delivery reports during major contract months. April, May, July, September, and December are the main delivery months. Watch the standing for delivery numbers and compare them to historical averages. Third, monitor physical market premiums through dealer websites and precious metals news services. Track whether premiums are widening or narrowing. Fourth, watch the commitment of traders report published weekly by the CFTC. Pay attention to commercial short positions and whether they're increasing or decreasing. Fifth, track the spread between near-month and deferred month futures contracts. Backwardation, where near months trade at a premium to future months, is a sign of physical tightness. This is OG John AG. I've shown you what happened, documented it with official data, explained why it matters, and given you the tools to monitor the situation yourself. 14 million ounces left COMEX in 72 hours. This has never happened before in modern history. What happens next is unfolding in real time, and we're all watching it together. Verify everything I've told you through the official CME warehouse reports. Form your own conclusions, make your own decisions. And regardless of what you decide, stay informed about what's actually happening rather than relying on outdated assumptions about how these markets function. If you found this analysis valuable, let me know in the comments what you think happens next and what data points you'll be watching. Stay rational, stay informed, and base your decisions on verifiable facts rather than fear or hype. OG John AG out.